Hey folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update is for Monday, June 8th through Friday, June 12th, 2009. Well, folks, we had quite a week last week, really, with the big day being on Friday as the markets just whipsawed each way, initially gapping up on the strong jobs numbers that we saw out at 8:30 a.m. on the morning, and then ultimately selling all the way down, going negative, recovering, bouncing around the flat line, and ultimately closing flat on this Friday. You guys can see it all the way over here. I have the whole week set up so we can view it, what the week did. I want to kind of go over what happened last week, what are the key points from last week, and there are some major ones, folks. I'll tell you, this is all coming to a major point, and I don't think many people have any idea what's going on out there. I'm going to try to unveil it to you all so you have a good grasp on what to look for in the next coming week. But I'll tell you one thing, I'd say about 90% of it has to do with the bond market and the US dollar. This is what's going to be big. This is what is now setting up as a major catch-22 for the Federal Reserve, where they tried to do something and it looks like they may have screwed it up a little bit, and there's always a consequence. I can't stress that enough. When you intervene, and this has happened since, history, all throughout history, really, but going back to 2000 and the tech bubble burst when Greenspan intervened and dropped rates to near zero, and you had the bubble in housing start to develop there because of intervention. You're now seeing a different effect of the government's and the Federal Reserve's intervention. I want to go over that. But needless to say, you could see the markets on Friday. We had a strong jobs number come out where the expectation for job losses was in the 500 to 600,000 range for last month. It came in the 300,000 range. That was a very positive sign for an economy that's constantly looking for new things to run off of, whether it's new, kind of like a drug high. You have to continue to have that drug high. The markets continue to need that. And the gap up happened, but then people started to realize that it's maybe not as bullish as it seems, because what happens now is you're starting to see the dollar rally back. When the dollar rallies back, oil, commodities start to sink, and one of the largest components of the S&P is oil. So when the dollar moves higher and oil is forced down because of that, you can see sometimes how the market loses steam because those oil stocks begin to falter and kind of come back in from their monstrous runs that they've been on. So it's actually kind of an ironic twist where, the strengthening of the dollar actually is a negative for the markets, and that's exactly what you saw on Friday, where the markets gapped up in euphoria and then started to sell off as the dollar started to rally, oil started to fall back down to really around the flat line, going slightly negative for the day. Gold got smoked, absolutely smoked on Friday as well. Last week was an interesting week, though, and the interesting thing about Friday and the whole week last week, folks, is notice this blue line. On Monday, we gapped up and we went up right around this blue line, and we kind of ended the week right on it. I'm going to go back and show you. If you scan back here to the end of last week, or the beginning of the week anyways, here going back, you can see we had that monstrous run last Friday into the close, and then the gap up come in this last Monday, and you went up to right around this blue line. This is the same blue line we ended right above, and the 1030 high here, which was right around 94.50, 94.60, is exactly where the market ended on Friday, and I'll show you that. So you had the close a week ago from Friday right here, the gap up and the move up right into the 1030 time frame, and if you scan all the way through, and by the way, notice the channel that we developed early in the week, we came ultimately back inside that channel by the close after whipping around, same blue line right here, and look at where we ended, right above it as well. So kind of giving you a little perspective of how really ever since the Monday gap up at 10:30, we stayed straight sideways. I mean, whipsawed each way. As you can see on Friday, we were up here, going back to, Thursday, Wednesday, we were down here a little bit, and then ultimately kind of ending right on that same blue line. But the essence of what I was talking about, folks, and I want to go into it a little bit, then we'll go over these key levels, is really the catch-22 starting to develop. Now, the Federal Reserve, and this is the interesting thing, those of you that remember the policies of the Federal Reserve a month or two ago said that they were going to start, basically putting 1.3 trillion, a plan of 1.2 trillion into, push down mortgage rates, breathe life into the housing market. Remember buying up the assets, all that kind of junk going on, and they were going to use 1.2 trillion dollars 3 months ago, I believe it was, to do that. Well, it has a double-edged sword, and you're starting to see it, guys, and this is the scary thing about it, because as much as printing money is good to revive an economy, it has some negative impacts. And this is what the Federal Reserve, and this is why I scream and yell and rant and rave about why the government cannot constantly get involved. Because they always do something. Their intentions are positive. I'm not debating their intentions, but it constantly has an effect that they don't see. They're humans. They don't see all angles of the curve always, all angles of the triangle, whatever it may be. And what's going on now is when you start printing money, interest rates and yields start to rise, and all of a sudden you have the 10-year, which was 2.5% a month ago or so, or a month and change ago, is now closing in on 4%. And the negative about that is that it's going to kill the refinancing, which is people trying to lower their mortgage payments. Anyone that didn't refinance is now has the rates gone so far up that they're not going to necessarily improve anything by refinancing. They can't lower their monthly payments. So that's one aspect. The other, so remember, what's been the cause of everything that's happened lately over the past 2 years? It's been the housing market, right? So when you have this situation that housing, now all of a sudden rates are starting to go up and it's pricing, it's going to start to hurt the recovery in housing, and that's been the bottom line of what's been causing the market to do what it did. Guys, it's been the collapse in housing, and if you're not going to revive housing, this market and this economy is not going anywhere. So all of a sudden you have that as a supplementary or a kind of a fall off of what the Federal Reserve is doing here by printing money, putting 1.2 trillion. Then there's the stimulus bills the government's doing. There's the bailouts of the banks. I mean, it's trillions and trillions of dollars, and the offshoot is that there's higher rates. There's just the rates cannot, they're going to just start to go up and up and up. So this is something you have to watch next week. Watch the rates. Where I think we're right around 3.8 and change now on the rates, and that is up a huge amount just in the last month or two, ever since the Federal Reserve really started to put this in play. The other issue is not only are the refis going to be hurt, but people that, let's say someone wants to go and buy a house, well, all of a sudden their monthly payment is going up pretty dramatically because of rates. Their 30-year mortgage now is in the 5.5 range, I believe, if you have decent credit. And this is a much, much higher than it was not long ago. It's approaching 6% and so forth. So there's a lot of offshoots here that are going to go against what they're trying to do. And this is, I don't see, and again, you guys know us. We've been on top of this from day one, but I had to rant and rave a little bit about this because I think it's such an obvious miscarriage and miscalculation. Again, Greenspan did it, and now you're starting to see some offshoots of negative things that are actually going to end up killing this market and the rally and the possible comeback. And you're going to end up, unfortunately, what I think is you're going to end up with a long just bottom phase in the economy. Yes, are we having a little bit of pushbacks, maybe not as many people getting laid off every month? Absolutely, but I don't think it's going to fully turn around. I think you're going to start sitting down here with little increases, but you're never going to fully go to where you're adding jobs anymore. You're just going to kind of sit there being really flat. You're going to have, 9 to 10 to 11%, even I think as high as ultimately 12% unemployment, and it's just going to be a long stretch of that, kind of like Japan, and I fear that as a big issue. So watch that, guys. I'm going to get onto the charts now. Let's focus on this. What you can see here, folks, these are your key levels to watch. I'm going to put in your minor levels next, but your big levels for next week, early in the week, are going to be 95.20-ish. This area right here, you can see was a big level early in the day, right around this 95.15 to 95.25 level. Below that, this 94.40 to 94.50. These are major levels. I really want to see a closing low below this 94.40 level, meaning a close below that in the week. Really, it's got to take out this 200 moving average on an intraday basis, and also this trend line. This trend line actually goes all the way back to last Friday. Remember, this was that head and shoulders I showed last weekend in the weekend video, where we were going to break down, and then they saved the market and rallied all the way up on that massive squeeze. Well, guess what? If you take that low and move it to the exact low here on Wednesday, it looks like, and then move it to Friday, that's exactly the low we hit and then bounced off. So look for this to get taken out. If this area gets taken out, you should go test 94.40, 93.40, 93.50 right down here, and then there will be some levels following that. Minor levels to watch next week for those of you that want to put them in your charts. You're obviously going to have the high up here. You're going to have a little bit of a pivot area right here, as you can see right here at 95, just a little over 95 right here. Afterwards, you're going to have this pivot low right here. You can see how this low meets with this low right in here, as well as the 200 moving averages. These are really the levels you're going to watch. Obviously, the high pivot right from here will be somewhat of a minor level, but these are the ones that are dashed are very, very minor levels. Here's another very, very minor level you can watch as well. And then if you start to sell off, really down here will be another one as well. So those are your minor levels, folks, that you're going to watch. But I'm telling you, there's a lot of things. Watch the dollar. The dollar screamed up. Here's the UUP on Friday, folks. Look at this. Is where where it closed Thursday. This is where it ended. That's a huge move for the dollar. It's got to be watched. Watch yields. You can watch the TBT. Will give you a sense of how yields are going, how rates are climbing, and how the bond market is kind of developing here. But that's going to be a big thing talked about next week and in the coming weeks if it continues to rise. Take care. Have a wonderful week. We'll talk to you all next week. Come join the Research Center. Take care.